Imagine a parallel financial universe where the rules are rewritten daily. A place where fortunes multiply in silence while the rest of the world fights over scraps. You've been told to invest in stocks, save diligently and avoid debt. But what if I revealed that the ultra-wealthy ignore every one of those rules? They're secret, private credit investments. Here's the unsettling truth. While retail investors chase single-digit returns in public markets, billionaires tap into a shadow economy. This isn't about stocks or bonds. It's a clandestine network of loans between corporations, governments, and ultra-wealthy individuals. A market valued at over $1 trillion. Returns here aren't measured in percentages you'd casually mention at a dinner party. We're talking double digits year after year, shielded from the volatility that crushes average portfolios. How does it work? Picture this. A billionaire's family office identifies a struggling telecom company in Southeast Asia. Instead of buying shares, they lend the company $50 million at an interest rate that would make credit card companies blush. But there's a twist. The loan is collateralized by the company's infrastructure. Towers, fiber networks, assets that print cash even if the business falters. When the loan matures, the billionaire either gets paid back with massive interest or seizes critical infrastructure to resell at a premium. You won't find these deals on Robinhood. Access requires connections forged over decades, minimum investments that start at $10 million, and legal teams to navigate jurisdictions where regulation is a suggestion. The kicker? These loans are repackaged into structured products, financial Russian dolls that distribute risk across hundreds of deals. When one fails, others compensate. It's a system designed to bleed value from every economic condition, recession, or boom. Now, consider this. The same markets that crushed your retirement fund in 2008 made certain families richer than ever. Why? Because private credit doesn't trade on public exchanges. There's no panic selling, no algorithm-driven flash crashes. Wealth grows in the dark, untouchable, while the masses fight over NASDAQ listings. What comes next involves shell companies, offshore havens, and a tax loophole so audacious it redefines greed. Stay locked in, the rabbit hole goes deeper. Beneath the polished surface of annual reports and press releases lies a labyrinth most will never see. A maze of shell companies designed to anonymize wealth and evade scrutiny. Let's dismantle the myth. Billionaires don't avoid taxes. They engineer financial invisibility. Take a typical structure. A holding company in Singapore owns a subsidiary in Malta, which controls a trust registered in the Cayman Islands. Each layer exists to obscure ownership, redirect cash flows, and exploit loopholes in over 100 tax treaties. The real magic happens when income transforms into debt. Here's how. A billionaire's offshore entity lends money to their onshore business at interest rates surpassing 20% annually. The business deducts these payments as expenses, slashing taxable income. Meanwhile, the offshore entity, located in a zero-tax jurisdiction, collects pure profit. Repeat this across 50 subsidiaries, and suddenly, billions vanish from government balance sheets. But the audacity doesn't stop there. Consider intellectual property arbitrage. A tech mogul transfers patents to a shell company in Ireland, where corporate taxes cap at 12.5%. That Irish entity then licenses the patents back to the parent company at fees consuming 80% of revenue. Profit shifts to low-tax regions, while operational costs stay in high-tax countries. The result? A Fortune 500 company paying less tax than a middle-class household. What keeps this system alive? Secrecy jurisdictions. Places like Panama, Luxembourg, and Delaware, yes, Delaware, offer laws that let companies exist without listing owners. Over 200,000 businesses incorporate in Delaware annually, many as anonymous LCS. Combine this with nominee directors, paid actors who sign documents, and tracing wealth becomes impossible. Yet the most chilling detail. Leaks like the Panama Papers exposed how 12 national leaders, 131 politicians, and thousands of elites use these structures. While regulators chase crumbs, the wealthy rewrite reality. But the ultimate power move isn't hiding money. It's hedging against collapse. What do billionaires hoard when they sense economic decay? The answer lies not in gold, but in assets that control the future. While governments print money and economists debate inflation rates, billionaires execute a silent takeover of assets immune to currency decay. Forget gold or Bitcoin. The real hedge lies in controlling resources that will define the next century. Let's break it down. When hyperinflation looms, the wealthy don't flee to cash. They corner markets for things you can't live without. Start with rare earth metals. Your phone, Electric car and solar panels rely on elements like neodymium and dysprosium. China controls 90% of global supply, but billionaires bypass governments entirely. One tycoon quietly acquired mining rights in Greenland for 30 years, a stash containing enough rare earths to power 20 million electric vehicles. These metals aren't traded on public exchanges. Prices get negotiated in private auctions, often tripling overnight for buyers desperate to secure future tech dominance. Then there's farmland, not just any dirt, strategic parcels near freshwater reservoirs and ports. A Middle Eastern sovereign wealth fund owns over 500,000 acres of Arizona farmland, tapping the Colorado River to grow alfalfa shipped back home. Others target Ukraine's Chernozem, soil so fertile, 1 acre yields 3 times more wheat than in Kansas. Control the breadbaskets, and you control survival when fiat currencies implode. But the masterstroke, decarbonization infrastructure. While politicians promise green transitions, billionaires buy lithium brine pools in Chile and cobalt mines in Congo. One hedge fund manager owns 6 geothermal plants in Iceland, not for energy, but for the carbon credits they'll generate as emissions regulations tighten. These assets form closed-loop systems. Mines feed battery factories, which supply the billionaire's EVA startups, which lease vehicles to his logistics empire. The pattern is clear. The rich don't fear inflation. They weaponize it. By dominating supply chains for essentials, food, energy, tech, they ensure their wealth grows as the dollar withers. But what happens when even this isn't enough? When survival requires not just resources, but rewriting the rules of charity itself, the darkest playbook awaits. Philanthropy wears a halo, until you realize it's the ultimate wealth multiplication hack. Here's the unspoken truth. When billionaires donate billions, they're not sacrificing wealth. They're executing tax arbitrage on a galactic scale. Let's dissect the machinery. Take charitable remainder trust. A tech CEO transfers $100 million in appreciated stock into a CRT. The trust sells the stock tax-free, reinvests the proceeds, and pays the CEO an annual 8% income for 20 years. Afterward, the remaining assets go to charity. The kicker: the CEO deducts the hypothetical future donation from current taxes, slashing their bill by $40 million immediately. They keep 80% of the wealth while society praises their generosity. Then there's donor-advised funds, the ultimate money parking lot. They claim an immediate tax deduction, then let the fund's managers slowly dole out grants over decades. Meanwhile, the initial contribution grows tax-free. By delaying actual donations, they effectively borrow from future charity budgets to enrich themselves today. But the most insidious play: funding research that circles back to their empires. A pharma tycoon donates $50 million to a university studying Alzheimer's. The catch: the research focuses on a drug compound his company patented 6 months prior. When the study concludes favorably, his stock soars. The donation becomes a marketing expense, tax deductible, and reputation laundering. These strategies pale against the nuclear option, using nonprofits to control governments. A fossil fuel heir funds environmental NGOs that lobby against nuclear energy, protecting his oil interests. A tech mogul bankrolls antitrust think tanks that coincidentally target his competitors. Charity becomes a legal form of corporate espionage, with every dollar spent multiplying returns through policy shifts. While you debate donating 10% of your income, the ultra-wealthy engineer scenarios where giving equals taking. But the final tier of financial dominance isn't about hoarding. It's about rewriting societal rules to ensure their offspring never face competition. The end game doesn't care about money. It cares about legacy. The game is rigged, but not in the way you think. Billionaires don't win by luck. They win by designing systems that funnel wealth upward, generation after generation. Shell companies erase taxable identities. Resource monopolies defy inflation. Philanthropy masquerades as profit engineering. Together they form an unassailable fortress, a wealth singularity where money begets power and power rewrites law. Consider dynastic trusts. A billionaire places 99% of their assets into a trust structured to outlive them by 300 years. The trust's beneficiaries, children, grandchildren, future descendants, receive annual allowances but can't touch the principal. Courts can't seize it. Divorces can't split it. One family in Europe has operated this way since the 1700s, their fortune intact through wars, revolutions, and economic collapses. Now layer generational education. Elite heirs don't attend Harvard for knowledge. They go to inherit Rolodexes. Secret societies and alumni networks groom them to take board seats, lobby governments, and marry into other dynasties. Their real curriculum? perpetuating closed systems where meritocracy is theater and bloodlines control access. But the ultimate multiplier, data colonialism. While you scroll social media, billionaires harvest behavioral patterns to predict markets. One venture fund buys psychiatric research to model how trauma influences spending. Another uses satellite imagery of parking lots to gauge retail health before earnings reports. When they donate to political campaigns, it's not ideology, it's algorithmic. Contributions target lawmakers whose voting patterns correlate with favorable regulatory shifts for their industries. It's capitalism's endgame, a world where capital detaches from labor entirely. The middle class shrinks not through laziness, but because the rules were coded by winners to ensure no one else cracks the vault. Your move? Share this video to rupture the silence. Smash like if you're ready to dissect systems, not stocks. And subscribe, because tomorrow's Exposed dives into how one man turned a prison sentence into $1 billion empire.